Most people today aren't trying to get rich, they're trying to replace their paycheck. Scroll through any finance content and you'll see the same goal repeated over and over. $1,000 a month in dividends, a rental that cash flows, a side hustle that runs itself. The dream isn't ownership or scale, it's stability. And on the surface, that sounds smart. Predictable income feels safe. It feels responsible. It feels like progress. But it's false. The uncomfortable truth? Passive income is designed to make you feel secure, not to make you wealthy. If your goal is a few $1,000s a month to reduce financial stress, passive income works perfectly. But if your goal is financial freedom, real net worth, or the kind of money that changes your options in life, optimizing for monthly cash flow is the wrong strategy. Because when you focus on income, you're optimizing for comfort, and comfort is the arch enemy of growth. In this video, you'll see why. The obsession with passive income isn't really about returns. It's about fear. Fear of losing your job, fear of relying on a single paycheck, fear of being trapped in a system that you don't control. Passive income promises an emotional solution, multiple income streams, money coming in while you sleep, a sense of independence from your employer. That's why the idea spread so quickly through the FIRE movement, dividend communities, and the build 7 income streams culture. It gives you something that feels like progress and control at the same time. And psychologically, it's powerful. Monthly payouts create constant reinforcement. Every dividend, every rent payment, every small cash flow hit feels like validation that you're moving forward. The problem is that humans don't optimize for long-term outcomes. We optimize for immediate emotional rewards. Passive income works so well as a concept because it feeds our need for certainty and feedback. But what feels good emotionally isn't always what works best mathematically. The real issue with passive income isn't the idea, it's the math. Most passive income assets generate low yields. Dividend portfolios typically pay around 3 to 4% per year. That means to generate $3,000 a month, you need roughly $1 million invested. Real estate follows a similar pattern. A typical cash flow focused property might generate $200 to $300 per month after expenses. To build meaningful income, you don't need 1 or 2 properties. You need a portfolio of 15, 20, sometimes more. And this isn't an accident. High cash flow almost always comes from assets that are designed for stability, not growth. When an investment pays you income today, that money is no longer compounding inside the asset. The higher the yield, the lower the expected long-term growth. Passive income strategies, whether dividends, rates, or high cash flow rentals, all make the same trade-off. They exchange future scale for present comfort. And over time, that trade-off becomes very expensive. The real danger of chasing passive income isn't what you earn, it's what you give up. When your strategy is built around monthly payouts, stability, and low volatility, your capital gets pushed into assets that are designed to move slowly. Your focus shifts to protecting income instead of growing equity. And over time, that mindset limits your upside. Compare 2 paths. One investor builds a dividend portfolio yielding 4% and reinvests steadily. The other concentrates capital into assets with real growth potential, a scalable business, career leverage, value-add real estate, or high-conviction equity positions. The first path produces predictable income. The second generates ownership in something that can multiply. Both feel disciplined, but only one has the potential to change your net worth in a meaningful way, because income pays your lifestyle, but equity changes your life. If you look at how most wealthy people actually got there, the pattern is very different from the passive income narrative. Real wealth rarely comes from steady monthly payouts. It comes from owning something that increases significantly in value over time. A business that scales, equity in a growing company, real estate that appreciates while being leveraged, a concentrated position in an asset that benefits from a major trend. And the process doesn't look comfortable. For years, there's little or no passive income. Sometimes there's no income at all. Everything gets reinvested back into growth. Then, instead of a small monthly payment, the wealth shows up in large sums. Business sale, refinancing event, a major reevaluation, a period of strong market expansion. Wealth isn't linear and predictable. It's uneven, delayed, and lumpy. But that's exactly what allows it to grow to a scale that monthly cash flow almost never can. Every dollar you pull out for income is a dollar that stops compounding. That's the hidden trade-off most people never see. The passive income mindset asks, how quickly can this asset start paying me? But the wealth mindset asks a different question. How long can I keep this capital compounding? Early income extraction slows everything down. Dividends taken instead of reinvested. Rental profits spent instead of redeployed. Business cash flow used for lifestyle instead of growth. Each decision feels small, but over time it dramatically reduces your trajectory. Compounding only works when capital stays inside the system. This is why real wealth often looks uncomfortable from the outside. For years, there's very little lifestyle improvement because almost everything gets reinvested. But that's how escape velocity happens. Not by optimizing for what the asset pays you today, but by maximizing what the asset can become tomorrow. Passive income isn't bad. It's often used at the wrong stage. Cash flow makes sense when you already have significant capital and your goal shifts from growth to stability. At that point, the objective is no longer to multiply your net worth, but to protect it, smooth volatility, and fund your lifestyle without selling core assets. The problem is sequencing. Wealth building typically has two phases. Phase 1 is accumulation, concentration, aggressive reinvestment, and focus on assets that can grow. Phase 2 is preservation, diversification, income generation, and stability. Most people try to start phase 2 before they've completed phase 1. They optimize for safety before they've built something worth protecting, and that decision caps their long-term potential. At its core, the passive income obsession isn't about money, it's about certainty. People don't chase dividends and cash flow because the returns are superior. They chase them because predictable income feels safe. It reduces anxiety. It creates the illusion of control. Knowing what money will arrive every month, no matter what the market does, is emotionally reassuring. But certainty comes at a price. Assets that feel stable are usually priced for stability, which means lower growth and limited upside. In other words, you're paying for emotional comfort with long-term performance. And that's the hidden trade-off. The safer the strategy feels today, the more it may cost you tomorrow. Because in investing, psychological safety and financial acceleration rarely come from the same place. The problem isn't that people want passive income. The problem is that they are optimizing for the wrong metric. Instead of asking, how much monthly income does this generate? The more important question is, how much can this grow my net worth? Because income is linear, increases slowly and predictably. Equity is exponential. It compounds, scales, and occasionally jumps. That shift changes how you think about opportunities. Instead of chasing yield, you look for assets with asymmetric upside. Instead of spreading capital across many small income sources, you concentrate where you have real insight or leverage. The focus moves from cash flow today to ownership, growth rate, and capital deployment. Because the goal isn't to build an income, the goal is to build something that becomes large enough that income is no longer the constraint. If this made you uncomfortable, that's a good sign. Because the real barrier to wealth isn't a lack of motivation, it's the gap between wanting high growth and being willing to accept what high growth actually requires: concentration, uncertainty, and risk. Most people say they want to build real wealth, but they choose strategies designed to feel safe instead of strategies designed to scale. That trade-off decides their financial future. If you want growth, but you don't have millions to start with, then the question becomes, where do you actually get leverage from zero? That's exactly what I break down in the next video. How to get rich through real estate, starting at zero. Because wealth doesn't start with passive income, it starts with a position that can grow a lot.